I'm Alicia Hyatt, editor of Mining Markets Magazine, and I'm here with John Gravelle, PwC's mining leader for Canada and the Americas. Welcome, John.
Thank you, Alicia. Nice to be here.
PwC does a report every year on the world's top 40 mining companies. Last year, you reported on the growing disconnect between high profits for these companies and declining share prices. And this year, the companies are in a full-blown confidence crisis, as you term it. How did we get to this point?
Well, the mining companies did search over the last 5 years for a number of projects in new areas. With the rising commodity prices, they really wanted to get more production online. However, what's happened now is a lot of those projects have not worked out, so there have been very substantial write-offs in the mining industry, and the operations they do have, the costs have gone up and the profit margins are being very squeezed. So we have cost overruns on existing projects, lots of write-offs, and not as much profits as they should have.
The industry is retrenching and contracting right now. Net profits for the top 40 companies were down by almost 50% last year. Are we seeing the end of the commodity supercycle?
I think what we're seeing is companies not chasing top-line growth as much as they were before. The markets have very clearly told them they need to focus on the bottom line, and the industry has that message and is acting on it. The golds were the first to start with that, with really getting that bottom line focus, and the rest have also followed suit. So that's what the market's doing now. They're not chasing top-line growth at any cost. They're looking at bottom line profitability, earnings per share.
And you don't see this downturn lasting very long. Can you tell us a little bit about that? How long do you see it lasting?
Well, I see there's still being good demand for minerals. So I still believe in the China story. China is around 50% urbanized. I think it'll try to continue urbanizing until it's well over 80%. That's been the roadmap for getting the country out of poverty, and I can't see them stopping that. So the demand side will continue to be there. However, China also has an inflation issue. They had prices really shoot up around a year and a half ago, and they're not going to continue to grow while risking higher prices, especially higher food prices. So I think demand's going to be there. It's not going to be as strong out of China as it was in the past, but I think it will still be there. As for the mining industry, the investors have left because of a lack of confidence that they can generate profitable growth. That's why the investors left. So now what we need to see is the big companies turn around profitability. I hope that'll be in 2013 that they'll be able to do that. And there is a major focus by the big companies on doing that. Once they turn around profitability, can demonstrate that they can act profitably, confidence will come back, and that's when the investors will come back and the markets will turn around. Now, unfortunately, I think we're going to need the big guys to turn around before the small guys do, but I think that's what I see happening.
One of the trends that the report noted is that financing is drying up from the traditional sources and moving to private equity in the U.S. and Chinese companies. What does that mean for the mining industry?
Well, it's very fortunate that those alternative sources have been there. So yes, there's a little bit of private equity starting to come in. In my mind, I think I see that as being positive because they tend to come in when they sense the bottom is hit. So hopefully that means we're at the bottom and we're now coming out. But the other sources of financing have been great for mining companies because they've allowed them to continue to bring their mines further along and develop. So we've seen some high yield debt, and we've seen some Asian investors come in to projects, especially in the Labrador Trough in Canada. We've seen a number of investors there. And that I see as being positive too, and validating my view that the China long-term demand is there from China, because we have Chinese steel companies making investments in iron ore properties in Quebec. So that means they must have confidence that the steel market is going to continue to be there in China, and that iron ore will continue to grow.
On the junior side, we're seeing a lot of concern about the TSX Venture Exchange, and the juniors have been in a declining and downturn for the last 2 years. Have you ever seen it this bad before?
I have not seen it this bad, and it does worry me. As I said, the big companies have to turn around before the small ones. Trying to get general investors to come back into mining companies is enough of a challenge, and the big companies are now working on that. However, with the junior market being higher risk, money has to come back into the sector first, and then it'll come into the junior sector. So unfortunately, I have a hard time painting a rosy picture for the juniors over 2013.
So what kind of juniors are likely to survive this period of turmoil then?
The ones that have some production will be better able to survive because they have some cash flow coming in. The ones that don't have any production, they're the ones that are being challenged. And then of the ones that don't have any production, the ones that have, like as we talked about earlier, an Asian investor that's willing to put some money in to keep the exploration program going, those have a better chance. So first you need to have production is best, so you have cash flow coming in, and second, if you don't have that, an investor who's willing to keep putting some money in until the markets turn around, and then so they can get there.
Thanks so much for your insights, John.
Okay, my pleasure. Thank you.